I only would invest in deals that make sense.
Welcome back to the Freedom Real Estate Podcast with your boy, Andrew, and I am excited and ecstatic to have Elliot Schneider here. He's an absolute killer. This guy has been in the game for 40 plus years, has done development, has done land, and now is in hard money, was one of our prominent hard money lender, knows a ton about real estate investing, and he's going to be breaking it down in this episode. Come check it out. How you doing today, Elliot?
I'm doing fantastic. As you know, I'm in sunny Florida, but I'm very happy.
Amazing. So, Elliot, you are looked up to among many in our investing community. You have been in the game longer than most people I know. You've done so many unique deals. So bring us back to the very, very beginning. How did you get started in real estate in general and hard money? Are you an investor? What is your story?
Well, I started in real estate actually in the late 1980s. My former, and I won't go into the whole thing, but my former businesses were all automotive related. And actually somebody came to me and they wanted us to invest in a project in Hyannis. And it was the state's first 40B, which is affordable housing project. We did it just in time for, it was 1987 for the first stock market crash of my career. Wow. But it was 74 units and it sold out absolutely beautifully. So I said, hey, I'm very much into real estate at that particular point.
So let me get this straight, Elliot. For your first real estate deal, rather than starting with a single family, you decided, I want to do a new construction, 70-something unit building. Am I understanding that correctly?
Yeah, somebody invited me into the deal. Okay. It was very early in the States. If you're familiar with 40B, it's affordable housing.
Please educate our audience.
Well, 40B, general construction or general new building is 40A, which is where you go through your individual town. 40B is a methodology if you do, at that time it was 25% affordable units. You can double, triple, quadruple. You can go anywhere in the state. The only way that effectively they can turn you down is because of safety. And by that, I mean, you're coming out into an area of high traffic or something like that. We had, was the first one, we had one meeting before the Zoning Board of Appeals and we were approved. It's a whole different ball game today. It's much more difficult process, but back then that's how I entered real estate. And from there, I started actually developing. I went into land. And developed the land and then built new houses on it, mostly out where you are now in Worcester County.
Okay. I think some of your niche circled around like understanding zoning and understanding how to utilize land in the best capacity, the best ability, right?
Yeah, exactly. I loved land. I started off with land. But basically, the one thing I've done in my life is I'm not creative, but I'm a very good imitator. Okay. Kind of like what you're doing. Okay, you see something that works. Okay, you try to improve on it. You try to make it a little bit better, and you kind of keep doing the same thing again and again, and until hopefully it doesn't work anymore.
Okay, so you just more or less just double down on land, and over time you just built more and more and more experience. And over the years, you just learned, you put many tools in your tool belt, right?
It was a phenomenal business till about 2009 when the housing market crashed. And at that point, I had way too much land because I thought it was going to go on forever. Okay. But it didn't.
So at that point, what did you do?
At that point, I had to work out the stuff that we had. So we did it. It was very difficult. We actually sold a bunch of stuff for a loss. And eventually we got to the point around, 2011 or 12 or 13 that we started making money again. But it was a much more difficult business. So that's when I switched into really lending, although I'm still building somewhat. I have like 4 projects going on right now, but I don't do too much of it anymore. Like I say, 2008, 2009, the housing market literally crashed. I mean, it was just so easy. I'd buy a piece of land. It was very easy to subdivide it. I'd throw some houses on it and they'd go up $10,000 a week or something like that. It was as easy. And then obviously, I don't know if you guys are pretty young, you weren't around then. Overnight, the market crashed. And there was, because basically what was happening is lenders and realtors and developers were all making up stories to create developments. And they loaned money to, a lot of people that really shouldn't have money for housing. I mean, there's a lot of movies, etc., that have been written about it. So, I was stuck with a lot of land. I worked my way out of it. Actually, I still own some. Okay, about 16, 17 years later, I guess. But at about somewhere around 2011, 2012, there was this massive interest in flipping homes. There were all of these repossessed homes and it might have been 2013. I think it was 2011 and 12.
Mm.
And basically there were these marketing companies, that were basically trying to sell these properties to whoever would buy them. And there arose a bunch, really, are you familiar with REIAs?
Yes.
Okay.
Oh, real estate associations, like
Right. And there were meetings,
yeah.
Down, all over the whole area.
Essentially, I have a quote unquote RIA that I host, right? More or less.
Yeah. Yeah, are you literally a REIA? I mean, you have to.
We're not. I mean, we're like a group, but yeah, we're not.
No, I know. Which, when I get back from Florida, I'm definitely going to attend your group because I hear it's fantastic. But I'll just stop for a minute to compliment you. I follow you online, and all of the things that you're teaching everybody are just phenomenal. But in any case,
Thank you.
So, this whole market arose, and there's, there, and at these REIAs are I might call them like gurus, and they're teaching everybody how to flip houses, etc., like that. And along came this, I went to one of the meetings, and it was actually in the Cape Cod. And there was a woman there. Her name was actually Ann Bellamy. She's recently passed away. And she was like she was like one of the first lenders out there. And being an imitator, I kind of listened to her and I said, hey, this sounds like a great idea. And I basically at that point decided to get into the lending business.
Interesting. So one similarity I see throughout your entire story is, like you mentioned, you imitate other people where you see success, but you're also really good at recognizing, investments early in the cycle, right? Like you realized land very early in the cycle, you got involved, right? And then you also realized hard money lending very early on in the cycle and got involved very early, right?
Right. And my problem is I always stay in too long. But but at the moment, I'm still lending, and I also with some partners, a couple hundred apartments, and a bunch of other rental real estate, kind of similar to what you're doing, but just we did it kind of differently. But at that point, it was relatively easy to raise money because money was 2 or 3% in the bank back in 2009 and 10. So you could borrow money at 3% or 3.5%, and you know what hard money rates are. So it was a pretty easy business at that particular time. And we went to investors, people looking to put money out in the street, and we said, okay, we'll give you 6%.
Yep.
And then you put it out at 12 and 2 or 14% or whatever. So it was amazingly, again, pretty easy business at
It's
that particular time.
First of all, it's ingenious. But second of all, building wealth is not rocket science. Like, we all use the same recipes. It's simply arbitrage, right? You understood that you could borrow money at one rate and you could lend it out at a higher rate and collect the difference, right?
Absolutely. I agree with you. But building wealth, as you know, is also saving money. Okay. And not being, I had some other business interests. I still own some of my automobile businesses. My son runs those. So I always had an income coming in,
Mm-hmm.
and everything else, I just completely always rolled it over. And I believe very much in saving and building wealth,
Totally, and living within your means, right?
living within your means, right?
I'm a multimillionaire, and I just bought a house hack. I bought a 2-unit. I'm living in one unit. I'm renting the other unit. Like, I could easily afford a single family, but like, I don't want to let life creep up on me.
You don't drive a Ferrari, and you only go to steak dinner sometimes. No, this guy's very frugal. I do respect that.
Yeah, no, but I agree. But if you live, in that, and also if you're owning that house or that 2-family or whatever, you're building more wealth. Okay, because we're I don't have to tell you, we're in an inflationary environment somewhat, and the price of housing keeps going up. And so, meanwhile, if you're living there, you're just building more wealth.
Andrew and I have the same bug stuck in our head that we refuse to live in a house that somehow doesn't generate wealth on the side or other people aren't paying for. We like to live in a place where we have tenants and multiple units.
Definitely.
Yeah, 1982 or so, I bought a multifamily to live in Brockton. I paid $32,000 or something like that for it. I just 1031'd it. I kept taking money out of it. It was interesting because when in the in the early 1980s, we were coming out of the Jimmy Carter era. Interest rates for a home were about 16%. I managed to get a loan through a credit union, was based on the 6-month T-bill rate. At the time was about 6%. And it was adjustable. And the rate actually went down to lower than 1%.
Wow.
At one time. That's the only mortgage I think I paid off 30 years. And I think I told you I just 1031 the house. It was about $750,000 or $800,000.
Absolutely incredible. But it's funny because you got started in real estate just how we got started with a house hack, right? But you just didn't call it a house hack back then.
No, I'm not following you. What'd you call it?
A house hack, when you move into a multi-family unit as your primary residence.
Yeah, no, absolutely. And, and I think people are still doing that, but we lived in that, era between really, the early 80s when rates moved down for almost 40 years till 2022. So when they started going up again. So if you lived in that era, every time the rate moved down, the price of assets basically increased. So it was a lot easier than it is right now.
So Artem is more of a newer investor. So from a newer investor's perspective, what questions would you have for an experienced hard money lender like Elliot?
So one thing, actually, because you have such a wealth of knowledge, I did want to ask, a lot of younger people today say owning a house is difficult because rates are high, affordability is not so great because the price to buy a house is high, and basically the economics don't work out so much. Everybody says, oh, it was easier back in the day because houses were cheaper, but you say, well, rates were higher. But it seems like it's difficult when you have both high rates and high prices. If you have high rates but low prices, it's okay. If you have low prices, high rates, it's okay. So in your experience, is today actually that difficult, or it's just the bump in the road, and in the grand scheme of things, it's not really that much more difficult or more expensive than it was throughout history? What's your take on today's?
So if you, and I still have a lot of loans out with people, but I would say, that if you're looking at somebody like Andrew, he's buying stuff for like $100,000 a door. Okay, so that whether that's $500 or $600 a month at 6% or something like that, So I think to start off with, you have to buy a multifamily of
Mhm.
some type. And, either, maybe, I would say at least a 3-family, and attempt to live there and, and build wealth that way or start that way.
That's
And,
the only way in the door these days.
what's that?
That's pretty much the only way in the door these days into
I
investing.
think it's the only way in the door. You're certainly not going to go out into Westwood and buy $1.5 million house. But if you start with that multi, and there's still, and where if you follow the financial market, and I do completely, okay, you can see, inflation is still 2.5%, 3%, somewhere in that. So if you buy $800,000 house, that house is going up $25,000 a year anyway. And this morning I read in. Do you get the CRE report?
No, but I should start following it.
It talked about how rents now are stabilizing. They were going down for a little bit, but they're stabilizing and in going up around the country. So, I think you have to go into what you can afford. And, if you have those other 2 rents coming in, you're going to be able to nicely afford a multifamily. And you want to go into a city that's affordable. You don't want to go into Boston. You want to go out into, perhaps into the Worcester area or southeastern Mass area, even the Brocktons of my house was in Brockton. I lived there. And so, that's just a way to get started.
You know why I like you, Elliot? Because smart men think alike. Buying a higher cap rate market and multifamily. That's the way I like to roll as well. So.
Yeah. And I mean, well, I don't want to say, following you with your funds and everything like that. I mean, I never did anything like that. We hit another recession in, can't even think of what year, but basically, that's the way to, to get into the market. And even if you hit some rough patches, generally rents are going to pretty much stabilize, and you can run your property until things start appreciating again, as they will.
Yeah, I mean, a lot of my friends say, "Oh, it's not a good time to get into the market. I got to wait till affordability goes, down a little bit." I'm like, it's always difficult. You look at any era, there's something difficult. Just get in now. It never seems like a good idea now, but 20 years from now, you think, "Oh my God, I'm so glad I bought that property. You look like a genius." Just get in when you can with what you can, and then just wait it out. Over time, you're going to make money.
But if rates go down, generally prices go up.
Exactly. So
I think, and Andrew can tell you this, if you start looking at numbers, if the numbers work, if you have a 3-family and the rents are $2,000 or something, and you're bringing in $4,000 for the 2 other floors, and it's costing you, $3,500 or $3,800 a month, you're living there for free.
Exactly. Cheaper than rent.
Yeah.
I would love to pick your brain on exactly how lending works, especially as a hard money lender. I think as investors, we see the consumer side of things, like I have this property, I need to go get a loan, come to do the application. But I'm curious, who is on the other end of that? So like, where do you get the money to lend to those investors? What's their profile? How do you do those agreements, and where do you even find them? If somebody was to start a hard money lending business, who would they?
It's probably a little bit more difficult today. Okay. There's really 2 or 3 different types of lenders out there. And what's happened with lending has gotten, everybody's in the lending business now, or everybody wants to be in the lending business. And when I say everybody, I mean there's a lot of lenders. It's a very, very competitive environment right now. One of the largest players are something. Are you familiar with family offices?
Yes.
Okay. So a family office is a family, for example, the biggest one in Massachusetts is the Grossman family, actually. I don't know if you were familiar with Grossman's Lumber that used to be around. They owned a ton of real estate. Pretty much, I think they own outlets now, Grossman's Outlets. But what happened is the family opened up a office particularly for lending. They have all of this capital. Rather than put it into the bank at 3% or something like that, they put it out into the street. Then there's people like me. I have a number of investors, and I have my own capital after like 13 years. So we we generally use either investor capital or I came upon another um, method that I used, okay, and that was I would take my surplus cash. Um, I go out and buy a piece of rental property for cash. Um, I'm a little bit different than Andrew because I like single families. They don't produce as much revenue as multis. But if I bought a house for like $350,000, $400,000, and for a period of time we were renting to clients that had vouchers that paid a ton of money. We got anywhere between $3,500, $4,000 a month on a unit. So, so if I paid, say, $350,000 for the house, and so you get $4,000 a month times 12 is 48 grand. Okay,
That's
not
about
bad.
So it's funny because you've probably found another arbitrage. You found a city that paid an outsized amount if it's
Yes.
Section 8 rent in single family.
Yes,
That's what you're telling me,
exactly.
right?
Exactly. Unfortunately, it doesn't exist anymore. You, but what we did is we found low property value. Excuse me, we found values that weren't that high. There was a list that the state puts out of what they pay for vouchers. Okay. So now what we do is we take that house, we're renting it, then we go to the bank and we take an equity line on that house. Okay. And at one time it was 3%, and you put it out at 12 or 14%, whatever you can get. And so you're doubling or tripling the income that you can make on that property.
I mean, so what you're really telling our audience, it's an ingenious strategy that I've utilized, and it's the same concept as gerrymandering. You ever heard that, Elliot?
I thought gerrymandering was in elections, where they
Yeah.
pack an area, they throw
It's
a
when
bunch
they
of.
pack an area according to what voting demographic they want, right?
Yeah.
And the maps are all weird. They make absolutely no sense. You can take the same exact approach with finding that arbitrage that you mentioned called fair market rents, what Section 8 pays, right? And you can
Right.
pull that up on a map. And sometimes there's very depressed cities or cities that are
Yeah.
cheaper within areas, affluent areas, and you get premium rents at a really cheap price per unit. And that's exactly what you did. And you used that concept to build a whole portfolio of single family rentals.
So what's happening is, okay, you own these homes, you're building more wealth, and out of the wealth, you obviously have to pay your taxes, but you take the surplus funds and you go out, and you buy another house or two, and you keep doing the same thing until it doesn't work anymore. Somewhat more difficult now because the price of houses has gone up somewhat, and also the rate that you have to pay for your equity line has gone up also. So, but the other thing, not myself, that's the way that I basically operate my business. Okay. The third way that lenders are operating is with funds. There are insurance companies. There are other I can't think of the name of them offhand because I don't use them, but there are funds basically that loan to lenders, and there's
pension funds, I think you're thinking of.
pardon me.
Pension funds.
Anywhere, okay, but basically what they'll do is again the same thing. The lender will take the money, get it from the fund, and then arbitrage it, put it out on the street, and then pay the fund investors back. Some of them have their own funding mechanisms. I know you have a fund now, you have investors, I imagine, into it.
Yeah.
But, they'll have a fund, they pay the investors back, and then they arbitrage the difference. Some of them pay upwards of 10, 11, 12% interest. So they're working on a much thinner margin than I kind of work on. But they can get a lot of capital. It's a little bit harder today because some of these funds, if you follow Bloomberg and CNBC, some of these companies, it's private credit, which is huge. It's almost bigger than bank credit at the moment. Some of the private companies are in trouble. Not in real estate that I know of, but where they lend to, other companies, et cetera. So, so those are the three methods that you can use if you have a lot of friends and family that want to give you the money, but it's a very capital intensive business. And the other thing that you need to do, I don't mean to jump ahead of you, but the other thing you need is certain knowledge. You need to have a knowledge of land. You need to understand real estate values, and you really have to understand, to a certain extent, construction.
So I think that leads into our next question. It's like, when you get a deal brought across your desk, like, how do you know how to underwrite it? How do you know if it makes sense? Like, what goes through your mind if I brought a 5-unit deal to you?
Well, first of all, I know you.
Okay. So it's operator, that's number one.
The operator, right. So you really want to do business with somebody mostly that's experienced. If I ever get into trouble, it's usually with somebody that's inexperienced, okay? And they don't know what they're doing. So you try to get somebody that's experienced. And you look at the house and you look at the numbers. Most of us try to stay, and it's a little bit difficult right now, but we try to stay about 75% of what we think is ARV. Okay. Or if you know somebody that has a really good, have a lot of the same customers and they have a really good track record, you try to work with them and see if, but I only would invest in deals that make sense. If somebody brings a deal to me, even though they have the money, the track record, et cetera, and I don't think it's a good deal for them, I'm going to tell them, hey, stay away, or I'm just not going to loan on it.
What's the profile of the operator that you look for? Like, what's the minimum number of deals they have to have? What kind of track record? What kind of money do they have to bring to the table?
That's a very hard question. It's kind of open-ended. I don't have
It's somebody you've never worked with before. Like, how would you vet them as trusting them to be able to get it done?
Well, I think you want to talk to them. And you want to feel them out, and and see how much money they have to bring to the table, and see if they're experienced. And with everybody, you want to know what their exit strategy is, and sometimes they have more than one exit strategy, which is even better. And the one thing that we don't do is we're not allowed to own for somebody that wants to keep the house and live in it. We can't, by law, we're not allowed to do that. So we've done. I just talked to I only have one person that works for me, but since I've been in business, we've done almost 700 loans, and we've only lost money on one of them.
That's solid.
Yeah. Yeah. So we're careful. We try and work with people. I don't loan. Some lenders will loan to own. We loan to try to get them through the project so that they get to the next deal. Because inadvertently, sometimes people do run into trouble, and you want to kind of work with them and see if you can help them out and help them through the situation. It happens quite often, actually. So, but that's the way we operate our business. And as such, we get a lot of repeat business.
Nice. Do you have a lot of rules of your own, or do you have stricter guidelines that you have to follow based on the government, the regulations? Because I know a lot of banks that do conforming loans, like Freddie Mac, they have very strict guidelines. Do you get to create your own, and what are some of those?
Well, I love the bank guidelines, okay, because they create business for us. And I'm very sincere about that, okay, because they're so strict and they take so long that people get frustrated, and I'm sure I don't have to tell Andrew and hopefully yourself, but if that deal is a good deal and that's out there, I mean, there's 50 people that want that deal. And so, the one thing as a private lender that we make a decision, and, you call up and they say, hey, I have a property, and I'll look it up in Zillow, and they'll say, well, I need a funding letter, so, very quickly we have to make a decision as to whether that's a viable deal or not, because, we're kind of on, once we give a letter, we're kind of on the hook for it. So do we have fixed rules? No, we have what we try to do for common sense. So where banks sometimes has very strict credit requirements, we're we're concerned about the equity. So somebody might have an issue, maybe where they went bad for some particular reason, but they're rebuilding their credit. We care about, we're just looking at the deal and really the viability of the deal and whether they have enough money to make monthly payments and they have enough money to put a down payment on the deal.
Mhm.
Yeah, so I mean, I think I love working with Elliot because it's like speed and ease. Like when I call Elliot, I tell him about a deal and he tells me he's good to go. I know he's good for the money. And then when I get the deal under contract, it's very easy for me to get my business plan to completion. I don't have to jump through a lot of hoops. Like I have worked with other hard money lenders.
Yeah, good.
And sometimes to get a draw is like pulling teeth, right?
Oh, yeah.
Mhm.
And, and I love working with Elliot because like, he there's trust in our relationship, and it's a lot easier to get a draw from him than other lenders, in my opinion. So
yeah, we pride ourselves on that. I mean, rather than send an inspector out there and take a week or something, we're actually doing something with Andrew right now. I said, hey, send me some pictures. I mean, why do you have to go out there? It's a different world, right? There's the electrical panel. We know we installed it. Here's the inspection report, et cetera.
sure.
I mean, but on the other end, it's not quite that, in viability, you definitely want to make sure the deal is viable though. And by that, I mean, you want to make sure, we're very, very careful with titles that we run, because if you make a mistake in that area, it can be really devastating for both the person that's doing the deal and yourself. So that's, so you really have to have a good attorney that you're working with, et cetera. And you really have to look at those values of the property. And then it's either myself or I have somebody that I work with, goes out and looks at it and makes sure that what you're looking to do with the property and what we think should be done with the property are pretty close.
Yeah, I mean, that's why I love working with you, Elliot, because there's so many times where you found items on title that I didn't even know about, and I've avoided a landmine, as a result. So, and just going back to my original point, it's like, it's very easy to work with you. But I still remember my first loan, like, that trust was established over time. I think for my first couple of draws, I had to provide a lot of documentation over time. That trust was developed. So, but ultimately, there is a use for Elliot, for hard money lenders like Elliot. It's, if you're just trying to close quickly, you're trying to bring the project to stabilization as quickly as possible and either refi or sell, like it's a fantastic option.
Yeah. And that's what pretty much all of us hard money lenders do. And there's guys a lot bigger than me, and then there's some a little smaller than me. So, but it's, if it's at the moment, it's a business that works relatively well. But I see a lot of newer people out there, and I see some of the things they're doing, and it's what can I say?
Yeah. Yep. So, Ellie, you've been in the game a long time, and I'm sure you have a ton of lessons that you can share with our audience. So bring yourself back to young Elliot, young 20-something Elliot, and think of 3 pieces of advice you'd give your younger self to be successful today.
Practice birth control.
It's a
And I'm
lot.
very sincere, okay? I started off very young in again, I think what you really want to do is to look around at people like you. You're giving away, and I mean this very, very sincerely, okay? You're giving away all of this knowledge for free, okay? You have all of these, webinars and things like what's going on now. And, and so basically, if people follow what you're doing or somewhat, okay, that they're going to be successful. And that's what you preach. You go to your rear. When I was younger, I started off in the automobile business, and I'm actually I was about 22 years old. And, and like I say, I didn't practice birth control. I ended up having to marry somebody. It was different era. okay, and ended up with like a pretty bad marriage. But I found this guy's name was actually his name was Joe Ford, and he he kind of taught me the ropes. I mean, about the automobile business, and I just went out and I mean, I could tell you some incredible stories about him, but Joe was he I worked for him, and I'm sitting in his office, and he comes in with this beautiful woman. He says to me, he said, "This is Mrs. Ford." I said, "Nice to meet you." A couple of days later, he comes in and with a different woman. He said, "This is Mrs. Ford." And about a week later, he comes in with another woman. "This is Mrs. Ford." He was married to three women at the same time. So, I had pretty he was a pretty eventful guy, but he was extremely good. I mean, the other thing that he did is he did, he made quite a bit of money he was a very handsome, good looking guy. And he worked for Arthur Murray, which, do you know who Arthur Murray was?
No, educate us.
Okay. Dance lessons.
Ah.
So he would give dance lessons to these women and sell them lifetime lessons. Okay. And then, I don't know, maybe, you dump them. So it was a very, very different world that, I learned in. But, the one thing that I did do is eventually I learned the business. I opened up a place in Brockton that I still own, was used cars. I then became the youngest single line Pontiac dealer in the United States. If you ever heard of Pontiac.
Yeah. Wow.
In 1978, I was 34, and then came the first Iranian oil crisis, and I was living on virtually nothing. I actually sold the dealership, and I was fortunate. And then I got wind of at that time auto leasing. So, which was very favorable because we were coming out of that recession. So we went into that business for a period of time. We opened a country called Clover Leasing in the city. We had a couple locations, and then eventually the government came along and made rules that made that very unprofitable. So that's when I kind of sidelined it into real estate, because I will tell you one thing. Okay, at the moment, nothing is ever constant. And, when you found this methodology, but in the background is other people that are very anti-wealth, okay, the younger progressive people, and they're going to try to find a way to take that money from Andrew, believe it or not. And I mean, and of course, the other thing in our state is, the potential of rent control, which could be an absolute disaster. And then, we lived it in the 70s. It was terrible. And I don't know if it's going to pass or not, but that's something we all have to be aware of if we're going to be in the real estate business in Mass.
Might have to pivot again. Who knows?
Yeah. Well, I mean, I think your story is a great tale of, you've got to constantly pivot and iterate to be successful in this world.
Yeah. I mean, I don't have an occupation. I'm not a lawyer. I'm not a doctor. I'm not an accountant. But you're an
entrepreneur.
I'm an entrepreneur, and I'm always looking. Of course, I'm about on the very end of my spectrum, but I was always looking for an Andrew, to copy. All right. So, and I think that's why people come to you and come to your meeting, and I love what you're doing. I think it's phenomenal.
I appreciate that. I mean, but to your point, all I did was copy other successful investors as well. None of this knowledge came from me. So
yeah. So, so basically, essentially, we're all doing the same thing until we can't do it anymore, until the rules change. And then we'll see what happens. But that's my story.
Thank you so much for sharing your story. So if the audience wants to reach out, potentially work with you, where can people find you? How can they reach you?
Signature Lending, they can just call me 508-889-1218 or ERS2171 @gmail, and I always get back to everybody. Very cool.
Amazing. Well, thank you so much for your time. And,
very nice to meet you.
Absolutely.
Okay, and just keep doing what you're doing, Andrew. You're amazing.
Yep. No, I just want to thank you, Elliot, because honestly, when I got into this game, you're always somebody I looked up to. You gave me my first hard money loan. You gave a shot for me and my partner, Zach. And it honestly set us up for success. So thank you so much.
You're very welcome.
Thank you for joining us at the Freedom Real Estate Podcast. Check us out next week and make sure you subscribe. Take care.
Okay, guys. God bless.